Welcome to the deep dive. Today, we're really jumping into a big pile of notes and articles
Yeah, a real mix.
all about money, building wealth, and honestly, some things that really surprised me. Like how much is just about your mindset?
And simple strategies, actually, not always complex finance stuff.
Exactly. We've got everything here, market indicators, little historical
Right,
stories.
so the plan is let's try and sift through all this, cut out the noise,
Yeah, skip the information overload.
and just pull out the really key nuggets, the stuff that gives you a clear path forward. It's about getting up to speed, like quickly but properly.
Okay, let's do it. So digging in, one of the first things, it seems almost foundational in these sources. It's this idea that money isn't purely numbers.
No, it starts deeper.
It seems to be about mindset.
Yeah, that's how it's framed. Mindset is the foundation. And they really focus on this contrast, this core idea, scarcity versus abundance.
Ah, right. Like feeling there's never enough
Yeah.
versus, well, believing opportunities are actually out there.
Exactly. And the sources, they really hammer this point. Shifting away from that scarcity thinking, it's presented as just crucial, like step one.
Crucial for what? For actually building wealth?
Yeah, for unlocking wealth, but also just for even seeing the opportunities that might be right in front of you. It's like it changes the glasses you're wearing when you look at your finances.
Okay. And related to that, before making big moves, there's a mention of financial red flags. Just knowing where you are.
Right. Sort of knowing the warning signs. Are you spending more than you make consistently? Relying on credit cards, maybe? Little things like that. Just being aware.
Got it. So check your mindset, check your current reality.
Hmm.
Then what? The sources seem to move pretty quickly into practical stuff.
They do. Once you're working on the mindset piece, it pivots right into, well, accessible strategies, things you can actually do.
Which is where that set it and forget it idea comes up. For ETFs, I like that phrase, invest without the headache.
Yeah, it's a
Yeah.
good one. They explain ETFs, exchange-traded funds, basically track big market indexes, like the S&P 500.
So you buy one fund and you're instantly invested in hundreds of companies.
Pretty much. You get that diversification across, say, 500 large U.S. companies if you track the S&P. It's presented as a really straightforward way to get market exposure, often with super low fees, and just let it ride over the long term.
Okay, simple enough. And then REITs, they called that the lazy investor's way to own property. That definitely caught my eye.
Ah, yeah, sounds good, doesn't it?
Yeah.
REITs, real estate investment trusts. They let you invest in big real estate projects. Think like apartment complexes, shopping centers.
But you don't have to actually buy them all.
Nope. No fixing leaky toilets or finding tenants. You invest in the trust that owns and manages those properties. So the idea is you get potential real estate returns, but with minimal hassle.
Okay, so mindset.
Yeah.
Simple market investing.
Yeah.
But the sources didn't stop there, did they? They went beyond stocks and funds.
No, they absolutely did. They highlighted this other angle, flipping for profit.
Right. Turning everyday finds into cash. Selling other people's stuff.
Hmm.
I found this part really interesting. It feels very hands-on.
It is. It's framed as a direct way to make money. Find something undervalued, sell it for more. And they even had that kind of quirky phrase, rebranding garage clutter as vintage investments.
Which, actually, that connects to something else. Mentioned that story about the Mona Lisa.
Oh, yeah, fascinating anecdote.
How its value just exploded after it was stolen and recovered. The painting didn't change, but the story around it did. The perception.
Exactly. It's a great illustration of that point. Wealth isn't solely about the intrinsic value of what you own, how the world sees it, the story, the demand. That plays a huge role. Perception is powerful.
Really makes you think. Okay, connecting back to practical stuff, let's talk about the millionaire teacher. This seemed like a really core part of the material.
Definitely. The big idea drawn from that is, well, pretty empowering. It basically says you don't need a six-figure salary, you don't need to be a stock-picking genius, you don't even need amazing luck to get rich.
So what do you need, according to this teacher's example?
It boils down to common sense, patience, and maybe most importantly, ignoring all the noise, especially from financial gurus trying to sell you complicated, expensive products.
So the core lessons are like super simple, be frugal, don't try to impress people.
Right, frugality beats flexing.
And use low-cost index funds, like the ETFs we mentioned. Is that basically it?
That's the essence of it, yeah. And that's why it's important. It makes investing feel achievable for anyone, even if you find finance, intimidating. It cuts through the myths. And it's pretty critical of those high-fee mutual funds that just nibble away at your money over time.
There's that analogy they used. Paying high fees is like being a clueless tourist in a scammy souvenir shop.
Yeah, memorable, isn't it? So the action step becomes really clear. Stop paying those high fees.
And instead,
Embrace the low-cost index funds. Automate it if you can just set up regular investments. And then let compound interest do its magic. Over years. Decades.
it leaves you with that question, doesn't it? If a teacher built wealth this way, on a normal salary, just by being disciplined and keeping it simple,
Yeah, what does that tell us about how complicated we think it needs to be? Maybe it doesn't.
maybe not. It seems more about consistency than complexity. Okay, speaking of markets, though, sometimes they feel really complex. How do the sources suggest understanding market movements without, getting totally lost?
Well, they introduce a pretty simple tool, the 200-day exponential moving average, the 200 EMA.
Okay.
Think of it like a long-term compass for the overall market, like the S&P 500. Often people track it using funds like SPY.
And the rule is simple.
Pretty simple, yeah. If SPY, the fund tracking the S&P 500, is trading above that 200 EMA line, generally the market's seen as being in a healthy uptrend.
Okay, above is good.
Below, well, that's when people tend to get nervous. It drops below the 200 EMA, and you often see headlines about panic, signs of trouble.
But wait, this connects back to mindset, doesn't it? And that famous Warren Buffett quote.
Exactly. Be fearful when others are greedy, and be greedy when others are fearful.
So when the market drops below that 200 EMA
Yeah.
and everyone else is freaking out,
Mm.
the material suggests reframing that. Instead of just seeing danger,
Yeah.
maybe see it as a potential opportunity, like a discount rack for long-term investors.
Like getting designer clothes on clearance because you expect them to become valuable again later.
That's the analogy used, yeah. And there's even a personal example mentioned, someone putting, I think it was $8,000 into SPY when it dipped below the 200 EMA based on the historical tendency for the market to eventually recover. It's not a crystal ball, obviously,
Sure, no guarantees.
but it shows that mindset shift, acting when others are fearful.
But they did add a warning, right,
Yes.
about trying this with single stocks. Oh, absolutely. Crucial point. Buying individual stocks just because they dropped below their 200 EMA, much riskier. You'd need a really strong belief in that specific company. The simpler, maybe safer way to apply this greedy, when others are fearful idea, according to the sources, is with broad market index funds, like SPY, or they mentioned Amundi Prime USA as a similar option.
So that Buffett quote, it's not just a nice phrase. It's about actively changing your reaction from fear to maybe making a calculated move.
Precisely. Fear often paralyzes people or makes them sell low. These sources seem to say building wealth sometimes requires acting against that herd instinct, but using simple, tested strategies.
Okay, so if we pull all these threads together, from mindset shifting away from scarcity,
To using simple tools like ETFs and REITs.
and maybe even flipping some vintage finds,
Right, or learning from the millionaire teacher about patience and let costs.
and understanding market dips not just as scary, but maybe as chances.
The big picture that emerges really is that wealth building isn't usually about one giant leap.
No lottery win needed.
Not usually, no. The sources really emphasize it's about the small steps. Tiny steps, sometimes maybe awkward steps, but taken consistently.
Like figuring out how to sell that first item online, or setting up that first automatic $50 investment into an ETF.
Yeah, or just researching REITs to understand how you could potentially own a piece of property investment without needing, a massive down payment.
Those little wins
Yeah.
added up over time.
Exactly. They compound. Small steps, small wins, consistently. They lead to the big results eventually. It's more about the process, the perspective shift, than finding some magic bullet.
It's about doing something, changing how you look at things, and picking strategies that you can actually start now.
Couldn't have said it better.
So, okay, we've dived into quite a bit here. The power of mindset, scarcity versus abundance, fear versus greed, simple strategies, index funds, ETFs, REITs, even flipping, the wisdom of ignoring complexity like the millionaire teacher showed us, and just the sheer power of small, steady steps. So here's a final thought, drawing from all this material. If building wealth isn't really about luck or needing some secret complex strategy, but more about mastering simple ideas and maybe crucially controlling your own reactions to the noise and the fear, what's one simple small step you could take, maybe even this week, to start shifting your own financial reality?